Welcome to the show. This is Lowcountry Money Talk, of course. I'm here at the desk with Phil Bloyd, who returns to us from Revolutionary Financial Group, and we have a lot to talk about, as we always do.
Yes.
Nice to see you.
Hey, good to see you, Jessa.
So lots to discuss. We're talking retirement, which is a great topic, of course, to talk with you about. We've got the expert at the desk. It's a tough time, though, for our viewers who are either in or nearing retirement. So we're discussing the perfect storm and all of the things that you need to consider and what's just really going on right now.
Yeah, there's a lot of challenges.
A lot of challenges. So just to name a few, of course, inflation, we've got market volatility, and then the T word, which is something we're always needing to consider. Taxes are a big part of our financial picture.
Should be fresh on your mind.
That's right.
Just came out of April.
Yes.
So it's a good time to look them over.
Absolutely.
I had a client come in the other day and I was looking over, I always ask for the complete tax return.
Smart, yeah.
So sometimes they'll bring in a couple of pages and I'm like, well, next time bring it all in. And then I found where they missed out on some potential tax harvesting, which maybe cost them a few $1,000.
Yeah, it's amazing how big of a difference that can make, and I've learned that from you. So lots of ways to make sure that taxes aren't costing you more than they need to, of course. But there's a lot of ways, of course, that we can sort of prepare and try and, I guess, avoid the storm and trying to really be ahead of things. And that's what you've taught me is managing challenges and having a plan for them is really a great way to avoid costly mistakes.
We can always plan for the worst, hope for the best.
Yes,
right?
Absolutely.
But in this case, we're probably getting the worst.
Yeah, we've got the worst.
So here's the thing. A lot of challenges for retirees today. As I'm writing my book still, it's taking a little bit longer than I thought, but I guess we have it in edit now. I feel like calling that book, I've retired hundreds of times.
You're right, yeah.
Because, I work with hundreds of retirees. So for 31 years, it feels like I've retired hundreds of times.
You have planned for retirement under all these different circumstances.
I jump in there with you. So, guiding the way, it's nice to have a guide when you're going into uncharted waters. So right now, we're still dealing with this sticky inflation. We get contradictory job numbers, which is really tough because when they report the jobs for the previous month, they always come out with a high number. But when we have the jobs for the following month, they revise the months before and they're really bad.
Yeah.
But people don't pay attention to that because they had we got this many jobs this month. Well, they don't, when they come out and downplay and say, well, gee, that was off by 60 or 70,000. If that would have been the number when it was reported, people would think a lot differently.
Right.
But they don't give the second tier much look. So we're getting some really, they'll report really good job numbers, and then on the revisions, they're really high.
Interesting.
Like tens of thousands, which is a big number.
Right.
So we're not really getting good data. So we're trying to make good decisions. The economy is slowing. All oil prices went down. That's an indicator of a slowing economy. Most analysts still think we're going to be in trouble through the summer. Now they're pushing the recession. Some people think we're already in a recession. Some people are saying the last quarter. It's just more of the same.
Yeah.
So we have
people
to plan
all
for
over
that.
the place too.
Everywhere.
So that makes it really tricky. I want to ask you some questions, and for our viewers' sake and my own, to kind of learn where your head's at with some of these things. But let's talk about retirement specifically in relationship to inflation and how it might be affected by this runaway inflation situation.
Well, we're paying more for everything. So it means if we're taking money out of our investments, we're taking more.
Yeah.
If those funds are coming from a pre-tax account like a 401k or an IRA, when we take more money, guess what we have to do?
Make more?
It'd be nice to make more, but we're not making more. This year started out okay.
This is why I'm not in charge.
But we're paying more taxes because those funds haven't been taxed. So we're taking the monies out to pay for the groceries, which are a lot more. And then when we take the money out, then we not only have to pay more for the groceries, but we have to pay more taxes.
You're getting hit twice.
Double whammy.
Yeah.
You know.
Well, make more could work.
Well, that's the idea, but
the goal,
we've got to
right?
have a lot of cooperation with the market for that.
There's so many things to think about.
Yeah.
Well, I've got more for you because obviously I need some help. We're going to unpack some more questions after the break on Lowcountry Money Talk. We'll be right back. Welcome back into Lowcountry Money Talk, asking Phil some questions today and talking retirement, which of course could be the perfect storm. We've got some more to discuss. Does that sound good?
Yes.
I'm going to keep rolling with our questions.
Do
I
it.
know you want answers at home. I do too. We were talking about runaway inflation before the break, and you said, well, what happens if you need to take more out because you're dealing with inflation? My answer was make more. You reminded me that we also have to pay more taxes.
Depending on where we're taking the funds, yes.
Yes. Okay. So let's go back to that make more though. So
Okay.
what are we going to be able to do?
Okay.
How do we protect our savings from the inflation issue that we're dealing with?
Okay, first of all, Jess, we want to make sure we don't get in a trap. Okay, because I believe that, we always talk about the rule of 100,
Yes.
right? So if we have the right amount exposed to the market, and then we have, as we retire, we have a larger part that's not exposed to market risk, we should be taking our funds from the non-exposed side right now, let's say. But even on the market side, let's say that we're poised to think, okay, if we have this market pullback that many analysts are predicting, let's say it comes in the summer, they're debating this, what is it, the debt debate, the debt ceiling rise. It seems like they do that every couple of years. So the market may start responding to that, but so far so good. But if we do have a sell-off, I think we could get better pricing on stocks and equities later in the year.
Okay.
But what do we do till then to make some more money?
Right. Yeah.
Well, what I've been looking at is like short-term treasuries. They offer like a 3 and 6 month treasury. So instead of just sitting in a money market at 1, if we think we're going to be sitting around for 3 to 6 months, maybe we can ladder some of these and get a better return on that money to help offset inflation, so that when as we're waiting for those better purchase prices. Now, what we don't want to do is we don't want to get so much in treasuries that we miss the buying opportunities on the lower stock price.
Yeah.
So I would recommend 3 to 6 months, but I wouldn't really go longer with the money that I want to buy equities. Elsewise, you could be stuck.
Right. And then the prices are low and you're missing out on the great opportunity.
You're waiting for maturity on a 1-year treasury saying, well, hey, I'm getting 5%, but when these equities start moving, a lot of those could move that quick in a day or two. So.
Yeah, 5% sounds great right now, but in 6 months or so, hopefully we'll be able to start bouncing back.
We need to keep our funds on the right side of the table. So what we don't want at risk, we protect that. Maybe we're taking income from that side. What we do want at risk, we don't want to get long on treasuries, because we want that just to be a temporary thing, because we want these to be in equity positions and stocks and things of that nature. So don't get confused on, what's what, but just something now because of the state of the economy. Maybe we just take some short-term interest on those instead of setting dormant.
Right, and watching things
Mm-hmm.
unravel. Okay, so getting back to inflation here, on talking about investments and risk, okay?
Mm-hmm.
So what are we gonna do when we're looking at our different investments? Which ones are getting hit the hardest by inflation?
Well, it seems like if we look at our equity portfolio or our stock portfolio, we're kind of what we call running sideways. So we had the tech stocks started out real good to begin the year, and then we had a week where they just ran down. They came back on Friday. It seems like we're just kind of running in place a bit. So maybe sideways on the market. I think we're in a stagflation. I mentioned that last year. Watch out for that. I think we're there. Stagflation. The prices keep going up. Not really much movement on the economy. So I think we're here. So your question was, which parts of our investments are getting hit hard? Well, You know, if we have money just sitting around and checking, you know, we talk about an emergency fund,
Yep.
6 months expenses. Well,
Yep.
why do we have 5 years expenses in there getting a 0%? A lot of people are pulling those funds and putting in short-term treasuries, and that's why the banks are having some big problems right now, because they're not
Gotcha.
paying us interest, so people are taking those funds out.
Okay. Isn't that interesting? Wow. Well, all right. We've got lots more questions to discuss, and this is such an interesting topic. We could be here all day.
Hey.
Maybe you'll stay with us. We'll be right back. Welcome back in. We're picking Phil's brain today. This is Lowcountry Money Talk, and we've got lots of questions for Phil. And here's the good news: he has lots of answers.
Yes.
You were back.
Yes, I'm back.
Okay.
Here we go.
We've been talking about inflation. We've been talking about, of course, how inflation is affecting our retirement and different investments. I think it's time to turn the tables a little bit and start talking about debt. And of course, we're talking about our country's rising debt because, as we know, this is very likely to have an effect on us. And how is the country going to deal with this? I mean, is there any other solution other than raising taxes?
I don't think so.
Yeah.
It seems like they just keep pushing it off. So the one thing, if anybody has any questions, and as we're going through this, they need to call in and get the Revolutionary Wealth Review.
Yes.
So we can take a look at everyone's individual situation and make recommendations for them.
Yeah, that's
So,
a great
You know, I just wanted to make sure. So if there's, you know, you have $500,000, you bring in your tax return and all your statements. We want to take a look at it, and then we can give you, through the Revolutionary Wealth Review, here's where you're at. You know, where do you want to go? We can give you some individual solutions,
Right.
and Rachel will be the one to call on that. Now, getting back to what we were talking about, so we're sitting on soon to be $32 trillion in debt. Interest rates on government securities are rising, meaning that we're going to need more revenue to pay the interest on the national debt, because it was basically, you know, 1 or 2% for 15, 20 years.
Right.
Now it's 5.
Okay.
So that's going to add even more debt. We've got a dysfunctional government. I guess most people would agree with me on that. They can't agree on anything. They don't care. They don't know what to do. So this is not going to help anything.
Yeah.
But, you know, we can take control of our own situation.
Yes. Help us.
So we can review all these things. Now, taxes are going to go up in the future. Most people would agree.
Yeah, I doubt they're going to be going down in a long-term
Right.
vision, right? Especially with the debt, like we're talking about.
We're setting on a tax bomb if we have a 401k or IRA that's not a Roth, because
Right.
it hasn't been taxed yet.
Right.
So we're leaving all this potential taxation on our life savings, and we have a dysfunctional government that can't decide on anything. So that leaves a lot of risk, tax risk, to your retirement savings.
And we always think about risk in terms of the market volatility. This is a whole different kind of risk. It's the tax bomb. I like that terminology.
If I had $500,000 in a pre-taxed instrument, and let's say I was going to lose 30% of that $500,000 to taxes, right? That's
Right.
150.
Yes.
What if they raise the taxes to 50?
Ooh.
Then that's 250. That's 100,000 different. That's a big thing.
Yes.
So we still have opportunities. We have the current, you know, Trump tax cuts from before. Those expire or sunset 2025.
Sunset makes it sound so much better, right?
Especially down here in the low country.
That's
so,
right.
so, you know, we have this year, we have next year, and we have one more tax year to figure out, hey, how much of this do I want to go ahead and pay taxes on while I know what the rates are, so I can configure that tax bomb.
Right.
Now, the other advantage, Jess, of that right now is the stock market's low. So
Yes.
if my equity side of my portfolio is down, you know, 10, 15%, and the taxes are down, it only makes sense to me that we go ahead and start paying taxes on this now.
Right, because it's less money and less taxes.
Right.
So you don't want to pay the taxes on money that's up.
Right.
Yeah.
So what most people are going to do, they're going to wait for it to come back up,
Yeah.
and they'll say, oh, well, maybe I should start moving this to a Roth IRA now.
Right.
Well, why don't we do it today? because as the market starts moving up potentially next year and it goes up, whatever the percentage, we already settled our taxes on that part.
Right.
So that part will grow tax-free and the government will not share in that.
It feels better paying it later because you're up and
put it off.
But
procrastination.
Actually this makes a whole lot of sense.
Well, plus you got your tax return in front of you because you just completed it.
Yeah, absolutely.
So bring it in, let's take a look, let's see what our wiggle room is, and let's say, okay, I had a couple come in the other day and it's like, okay, we could do 40,000 this year, so let's move 40,000 from our traditional IRA to our Roth IRA.
So smart. And that revolutionary wealth review Phil was talking about at the top of the segment, that's no obligation. You can call Rachel, lay everything out, and they'll walk you through some really important things about your financial picture. It might be surprising, so it's a great thing to do. Another great thing to do is make sure you don't miss the last segment that's coming up after the break. Stick with us. All right, this is the final segment of Lowcountry Money Talk for today, and we've been unpacking, unwrapping Phil Bloyd's mind today, or trying to. There's a lot in there.
We need to tell that to my wife.
Okay. And there's a lot of good advice. Yeah. There's so much to discuss, when we're talking about retirement. We're talking about it really being the perfect storm. We've got all kinds of market volatility. We've got taxes to deal with, of course. And inflation is really challenging. So we've kind of worked through a lot of these things. I want to discuss Social Security in relationship to taxes and how does this affect us in retirement?
Great question, Jessica. So most of our retirees, of course, are receiving Social Security. And Social Security, as they're going to know when they review their taxes after the show, because they got them done just a month ago or
That's
so, right?
Right.
So they're fresh on their mind. They're going to look on that front page about 3/4 down the page, and it's going to say, hey, this is what I got in Social Security. And over to the right, it's going to say taxable amount of Social Security.
Right.
So remember on our board, if not, maybe I'll bring that board out again and we'll talk about it another time. But to finish up, if my Social Security is taxable, which most retirees that I work with, their Social Security is going to be taxable. It's taxed at whatever their highest income tax rate is. So if their highest income rate is 12%, then it's like 20,000 your Social Security is taxable. Okay, it's taxable at 12%. If it's 22%, same. Okay, if the tax rates move up, or this current tax situation we're in sunsets, and we go back to the old way,
right? We
have a 10% bracket, 15% bracket, 25% bracket. Now we have 10, 12, 22, 24, and they're wide.
Yes.
Okay, so obviously if income tax rates go up, you could pay thousands of more dollars in taxes just because your Social Security is being taxed.
Yeah.
So most people are not keeping an eye on this. So they're like, well, I know I need to do my Roth conversion and this and that because I want to lock in the taxes for now. But when they're in consideration, they say, well, I'm going to wait till later. I don't want to do my Roth conversion because I want to pay taxes. Maybe they're not considering how much more they're going to pay in taxes on their Social Security as well.
Right.
So they could be paying $4,000 or $5,000 more a year in income tax.
Wow,
that's
amazing.
A lot.
It's a lot.
And if the monies that we convert over into that Roth, the first year it will count towards the taxation of your Social Security, but the next year and the following years it does not count as provisional income.
So you may as well do it now.
You should do it now.
Right.
And I know we'll have some discussions with accountants and this and that, but also usually when you're talking to these other folks, they're not considering, they're just like, well, if you convert over 50,000, this is how much you're gonna pay in taxes. I don't know if it's they're not considering that this money's invested in equities, which are down.
Right,
okay.
Right. They're just looking at the
They're just saying, 50,000, this is what it costs you in taxes. Let's put that off for another 10 years. And then you wind up in a big hole and a big mess.
Right.
and you're like, how do I get out of this whole mess?
Because you waited. Now your equities ideally have bounced back, and now you've got more taxes on more equities, and
your required minimum
taxes
distribution will be
Social
more,
Security.
which is going to cause your Social Security to be taxed more, and it's kind of a cycle.
Right.
So we know where we're at now. So now is the time to take care of the problem before it gets worse.
To your point, it's not going to get better as far as taxes are concerned. Okay. Well, if you want to have your freshly done taxes taken a look at by Phil and his team, this is a great time to do it. You've got all your ducks in a row, everything's sort of gathered, and they can take a look at exactly where you are in your financial picture. You call Rachel, get a Revolutionary Wealth Review, and a good client, of course, for Revolutionary Financial Group is $500,000 or more in investable assets. And I think it's just a smart thing to do no matter what happens, because at least you can sit down and have someone take a look at everything that's going on.
Now's the perfect time.
Yeah.
Because you have that return right in front of you. We can look at some of the mistakes that you made last year, and we'll have time this year so that we don't repeat the mistakes we made last year.
Yeah, so smart. Hey, we're not supposed to be repeating mistakes. We learn from them, so it's good. All right, Phil, well, thank you for letting us just roll through all these great questions. And thank you for watching Lowcountry Money Talk. We'll see you next time.